Welcome to this explainer. If you've been looking at the markets lately and feeling a little uneasy, you are absolutely not alone. We are going to break down the three converging macroeconomic forces set to hit in 2026 and how this truly unprecedented environment could either wipe out your portfolio or, if you play it right, build generational wealth. We're facing a historical convergence of events that might look totally chaotic on the surface, but underneath, they actually form a very clear pattern.
Okay, let's dive right into this, because right now, a massive financial countdown is underway. We are looking at a window of just 34 days where a historic shift of the Federal Reserve is going to collide head-on with global conflicts and skyrocketing tariffs to create an unparalleled market shock. Most people have absolutely no idea that these three distinct, incredibly powerful forces are unfolding simultaneously right now in the spring of 2026. I mean, any one of these events on its own would be a major headline, right? It'd be a huge hurdle for investors. But all three hitting at exactly the same time? That creates a scenario that demands our full, undivided attention.
All right, let's get right into force number one, the oil shock.
Back in February 2026, the geopolitical conflict between the US, Israel, and Iran effectively blocked the Strait of Hormuz. Now, if you aren't familiar, that is the vital corridor for 20% of the entire world's oil and gas. Daily ship traffic plummeted from roughly 10 ships a day down to almost zero, and the fallout was immediate. Oil spiked from $67 to over $111 a barrel. That is a 60% jump and the fastest increase we've seen in over 40 years. We aren't talking about a gradual price creep over a decade. This literally happened in a matter of weeks. The market instantly started pricing in the reality that every single item transported on a truck, a ship, or a plane just got significantly more expensive to move.
So what happens next? This massive energy cost increase absolutely crushes corporate profits and breeds what economists call stagflation. It's like throwing a giant wrench into the gears of the economy. Historically, this creates one of the toughest possible environments for the stock market, exactly like what we saw back in the 1970s. Think about it. When energy costs rise, transportation costs rise. When transportation costs rise, the goods you buy at the store cost more. Companies try to absorb these costs, but their profit margins shrink, and then their earnings reports miss expectations. So you get a stagnant economy suffering from high inflation all at the same time. It's a highly volatile mix, and it causes the market to react wildly to every single news brief about temporary ceasefires or treaties, creating these massive emotional swings for investors.
Which brings us to force number two, adding fuel to the fire, the tariff surge.
Remember the brutal 19% S&P 500 plunge back in April 2025? It wiped out over $6.6 trillion in just 2 days following Liberation Day and pushed the Nasdaq straight into a bear market. Well, even after the Supreme Court actually intervened to strike some of those tariffs down, new policies under President Trump replaced them through different legal avenues. So today, the effective tariff rate is sitting at roughly 10.3%. That is nearly 5 times the original rate, and it's the highest level we have seen since the 1930s. According to Goldman Sachs, American consumers and companies are footing the bill for roughly 82% of those tariff costs. This isn't just some scary news headline anymore, it's actively showing up in the fundamentals. Major companies, even giants like Amazon, are reporting that these tariffs are slowly but surely creeping into their cost of goods.
And to agitate this pressure even further, the S&P 500's CAPE ratio is sitting at roughly 39 to 40. That marks the second highest valuation in 150 years, surpassed only by the dot-com bubble. If you don't know, the CAPE ratio simply measures how expensive the market is compared to historical earnings. So we're sitting at near record high stock prices at the exact same time that consumers are feeling incredibly pessimistic, and the risk of a recession has doubled from 22% back in January to 45% today. The market literally has absolutely no margin for error right now.
Finally, let's look at force number three, the hawkish Fed, and a truly historic transition.
Wall Street entered 2026 completely banking on interest rate cuts to justify those sky-high valuations we just talked about. But if you look at how these dominoes are falling, things are playing out a lot differently. Right as inflation spikes from tariffs and oil, President Trump's nominee, Kevin Warsh, is set to replace Jerome Powell on May 15, 2026. Now, Warsh is a known hawk. In Fed terminology, that means he's someone aggressively focused on keeping inflation down, even if it comes at the cost of higher unemployment or slower economic growth. His track record shows he was even skeptical of cutting rates when the economy was actively collapsing back in 2008. So you've got a Fed chair who won't cut rates, combined with oil and tariff-driven inflation, combined with a historically expensive stock market. That right there is the perfect storm.
Furthermore, 2026 is a midterm election year under a new president. Historically, that drags market returns down to -7% due to policy uncertainty. Since 1957, midterms have created this slowdown in business investments and hiring simply because nobody knows what the government is going to do next. And the market hates uncertainty. But watch this post-midterm surge very closely. If you bail out of the market during those difficult midterm months, you completely miss out on one of the most statistically powerful 6-month rallies in the entire 4-year presidential cycle, which historically shoots up to a 14% return.
So what exactly is history's lesson here? Well, it reveals a massive wealth-building window. Despite this terrifying setup, dumping your shares in a panic turns a temporary paper loss into a permanent financial disaster. The people who got crushed in the April 2025 crash were the ones who panic sold at the bottom. They completely missed out when the market fully recovered and hit all-time highs less than 3 months later. The broader data absolutely proves this. Over any rolling 10-year period, the S&P 500 has been in the green 95% of the time. Think about that for a second. Out of 7,300 days in a 20-year period, if you try to time the market and miss just the 10 single best days, your entire generational wealth gets slashed by 50%. And by the way, 76% of those best days in history happen exactly during bear markets. You simply cannot afford to sit on the sidelines waiting for the skies to clear.
Real wealth is built during drawdowns. It's perfectly illustrated by Amazon. If you had panicked when their stock dropped 90% in 2001, you would have completely missed out on the spectacular 2,400% rebound that followed. Look, it's easy to buy stocks when the market is going up and everyone's cheering, right? But real fortunes are forged when you have the conviction to buy and hold great companies while everyone else is running for the exits. Drawdowns of 10%, 20%, or even 30% are not the end of the world. They are just a normal feature of how markets operate.
Even the greatest minds, like Warren Buffett, admit they cannot time the bottom. Buffett wasn't hoarding cash in late 2025 out of sheer panic. He was patiently sticking to his valuation principles. Similarly, legendary Magellan fund manager Peter Lynch endured 7 drops of 20% or more and 3 drops of 30% or more over his 13-year tenure. But because he stayed invested, he achieved one of the greatest track records in financial history, averaging 29% annual returns by simply staying the course. No one can perfectly time the market bottom. Not Goldman Sachs, not Warren Buffett, and for sure, not us.
So to survive and thrive in this storm, follow these 5 data-backed steps. Number 1, never panic sell. Number 2, aggressively dollar cost average to lower your average cost. 3, recognize that macro pressures, rather than failing company fundamentals, are driving the drop. 4, stick to high-quality S&P 500 companies. And 5, entirely abandon the idea of perfectly timing the market bottom. Dollar cost averaging is essentially a financial superpower. By investing a set amount of money at regular intervals, you naturally buy fewer shares when prices are high and way more shares when prices are low. Over time, your average buy-in price drifts remarkably close to the market bottom without you ever having to guess when that bottom actually is. Focus on companies you understand with strong earnings and recognize that the market is dipping because of oil and tariffs, not because these underlying businesses have suddenly forgotten how to make money.
Remember, a 25-year strategy of dollar cost averaging starting at the absolute peak of the dot-com crash still resulted in a 400% return, even if you started investing at literally the worst possible moment, right before the dot-com crash, followed by 9/11, the 2008 financial crisis, and the COVID pandemic. You still would have seen your wealth multiply if you just stayed consistent. The stock market is exactly what Warren Buffett says it is. It's a machine that transfers wealth from the impatient to the patient. So, as history unfolds over the coming weeks, are you going to let the headlines panic you, or will you use history to build generational wealth?